All right. So another week, week three now. We'll be talking about a lot of tax implication type things tonight, um, and some other topics. One thing though, a couple emails. I guess there's something switched with the e-learning people who proctor the final, and good on the people for being proactive, trying to get out there and get the proctor set up. Evidently, I'm going to find this out. I'll run it to ground tomorrow when they're open, but I'll call them. But I guess they've changed their requesting a proctor procedure where it's probably a little more seamless. I don't. Anyway, so we'll see what the truth is on that. But I think you don't necessarily need to schedule a proctor, but we'll find out tomorrow. But anyway, not a factor for quite a while as the midterm is straight off a blackboard and the only the final is proctored. So let's see. Yeah, tax concepts and planning. So taxes are pretty interesting, and you know there's a lot of reasons to be in business for yourself or to have a kind of a side hustle, side job, whatever. And one of those reasons is taxes. Even if it's, if you're working, say, for a corporation or the government or whatever, and you get your paycheck, and there's not, your taxes are typically quite simple, which isn't necessarily a good thing. It means you're going to pay, you know, a lot, um, quite a bit, or any case, if you're making a reasonable income, and you don't have anywhere to deduct and do things like that. Now, when I say even a small business, I mean that includes renting out a home or something, some real estate property. Just by doing that, I mean the tax deductions that become available to you as a homeowner, but also as a landlord. If you realize that not only can you deduct your mortgage interest, um, and also the property taxes, but also you depreciate that house. That's like done over 27 years and stuff. I'm not going to get into too much in the way of, you know, whatever deep tax law, but those depreciation amounts, um, and obviously the house 27 years from now is still, probably a reasonable house, maybe a good house. It depends on the neighborhood and a lot of other things that you have input on. But anyway, things like that can be done. People, for the most part, people don't understand taxes. Not at all. I mean, if you want to talk to somebody about taxes and they're say giving you advice, ask them about tax brackets. And if they can't explain it, then they don't know anything about taxes. It's not that hard a concept, but man, is it misunderstood. And just after tonight, and the lecture I'll have, and then the little YouTube video, you'll completely understand it. It's not that difficult, but you'll see people make just this, you know, I'm sorry, but stupid comments thinking that, oh, I don't want to make another dollar because it's going to push me in a different tax bracket. If they make a comment like that, they don't know what they're talking about, and you need to whatever. I mean, if they're a friend, you don't have to insult them, but if they're somebody you're paying to do your taxes or get advice from, you need to steer clear. So anyway, taxes are part of the economy, certainly. Earned income. You're it's kind of insidious. There's, when people think about taxes, they think about income taxes, on earned income. But just about everything you do, whether it's fees for registering cars, DMV, things they have as use fees, things that are built in like on fuel, gasoline taxes and stuff, sales tax. It's always amazing when you go to Europe, and they're paying, shoot, they've been paying lots of money for fuel, $6, $8 a gallon forever. And it's not that the fuel is a worldwide commodity, but the taxes they pay on fuel over there are incredible. Keep in mind the taxes we pay here are fairly hefty, but nothing in comparison to Europe and some of those places. They also tax you, yeah, wealth transfers, when corporate taxes are paid as well, which are obviously passed on to you in terms of purchase prices, and there's sales tax, and then there's capital gains. There's things that when you make money on investments, that's taxed, and then they have what they sometimes refer to as sin taxes. At least when they're talking about alcohol and cigarettes, some of those taxes are pretty darn high, and nobody can really object because you're you know viewed as a bad person, so they can you know anyway, it's almost like a victimless crime. They can go after people and you know there's not enough people to object to it, and they anyway we go on all night about this, but yeah, taxes you're paying a fair amount. Corporations pay income taxes on profits, and so this gets maybe beyond things, but when you're talking business formation and you're going to set up a certain type of corporation, you want to avoid double taxation. Whereas if you own the corporation pays taxes, and then you pay yourself, and guess what, you earned income, you get taxed again. So um, but for most corporations, the taxes that are paid are um, passed on in the way of the purchase price. Property taxes we talked about, government service and programs, and you're taxed at all the different levels. IRS, Internal Revenue Service. So, yeah, we talked about transaction taxes, withholding, and quarterly payments. Typically, with COVID, everything's jacked up. But these numbers, or certainly this number, December 31st, always stays the same. So if you want to look at your taxes and make adjustments and modify your behavior to, minimize your taxes or do whatever, it has to be done before the end of the year. So if you wait till April 15th to start thinking about your taxes, those decisions are already locked in. And one quick thing, I think most of you are smart enough to know if you're getting money back from the government, that's not necessarily a good thing. You're not getting one over on the government. They don't owe you money. They're, well, they do owe you money, but it's your money. It's if you, what you do throughout the year is you pay estimated amounts of what taxes will ultimately be owed to the government at the end of the year. If you're getting a big whopping refund and there wasn't some unusual situation, all you did was overpay your taxes every period, gave the government a free loan, and obviously time value of money, maybe not dealing with vast sums of money, but to the government it is. Try underpaying your taxes. They'll come after you and they'll make you pay penalties and interest. So I actually have a thing with the IRS right now. Not a bad thing. They owe me money because I refiled some tax returns, and they're paying me interest on the money that they owe me, but they can't seem to, get their bureaucratic whatever. It's been going on 500 and some odd days, probably 600 days now. So when they ultimately pay me the money they owe me, they're going to pay me that and interest. That's their rules. So it's a beautiful thing. Social Security, Medicare taxes, we know about that. Again, when you look at your paycheck and you see all these different little categories, yep. So we'll talk more about Social Security in a broader sense when we talk about retirement stuff. You have Medicare, Medicaid. Medicare is the one that's for older folks, right? 65 and above, typically. And then Medicaid is like a welfare medical program. Um, So, yep, 6.2. Now, if you have multiple gigs, if you have a couple different jobs and they're totally more than 118, first off, congratulations. But second off, you're probably going to end up overpaying the Social Security unless you tell the employer that, hey, don't deduct 6.2 because I'm making, say 150 grand and I only have to pay that 6.2 up to this amount. And this is 2015, so my number's getting dated here. So, anyway, it's probably 125 now. Medicare taxes 1.45, no sliding scale, and then self-employed. Yeah, you end up paying it just as well. Personal income taxes. So different forms, vary in complexity. Obviously, the 1040, you probably, I mean, that sounds counterintuitive, but you probably want to be filing on the 1040 once you know, put on your big boy pants and you're out there, investing and buying real estate and doing all that kind of stuff. Right now, if you've got a very simple system, simple life, you're probably, can do it 1040 easy. And you can probably even file online for free because the expectation of the software companies are that they want to develop you as a customer and they want to they basically want to hook you. I'll show you TurboTax here in a second. There's lots of different tax programs out there, but once you kind of get associated with one, you're apt to stick with it because it's got all your name and your data and your past records, and it just makes it so easy. And that's intentional because they want you back there every year. The deal with any of these tax software programs, or at least the ones I'm familiar with, they do not charge you until you file. So even if you're going to do your taxes yourself or have somebody else do your taxes and you just want to know about, tax information, well, what if I did like this or what if I got married or bought a house? I wonder how that would affect my taxes. You can go and use that software and do those calculations and not pay a dime. So anyway, we'll look at that a little bit tonight. So anyway, like I say, this April 15th, it's going to slide around. The IRS is swamped. I mean, literally all those reports that old returns I filed. I mean, I filed them first, but then I filed corrected ones with a new tax person. And believe me, I do my own taxes until I found a person who's knows more than I do, and whatever. I have no ego when it comes to that. She is saving me a ton of money. And anyway, so she looked at my previous returns and said, "Well, we can do this, we can do that," and it made sense to refile them all. But anyway, they all probably ended up. She worked for the IRS for a long, long time, and then she went to law school when she was age 63. So anyway, she's been around a bit, and now she does, taxes for folks. And anyway, she was able to refile all that stuff. But anyway, my point was she said that having worked at the IRS, she said they just get swamped and they just get all these bundles and bundles of mail and they'd end up in a big storage container and they get to them when they get to them. So it's anyway. People have a lot more fear of the IRS than this woman says is warranted. This is just a graph to kind of show you income tax. You can see that's only about, obviously you can't see much because the resolution is horrible, but about 50% is income tax. Here's a little bit of corporate tax. Here's some payroll taxes, other payroll taxes, a little excise tax, so some of those, special use taxes and then other taxes. So taxes are, gone from a number of things. I'm not going to get off on a political thing here, but you can make the argument that um, some of those high wealth individuals or high earning, if you're making, if you're a whatever, it depends how you're structured, but this is how it's paid. Percentage of income, tax burden paid by quartiles. So the top 20% per this graph. Anyway, you can look at the numbers, but there's lots of things that are different. Not going to go into the whole minimum wage thing. We got off on a tangent on this one year, but realistically, when people talk about a $15 minimum wage, that ship has sailed compared to the incomes of people, in the $150,000 range. Their incomes, their salaries have been going up quite well, and minimum wage is just kind of creeping along, and where it should be is up in the 20s. But anyway, um, so one of the first questions when you're filing your taxes is going to be your status. So you can file a number of different ways, and some of you may be familiar with this, some of you may not. But anyway, um, we have a progressive tax system, which that one chart showing 88% paid by the most wealthy people. That reflects a progressive tax system. Progressive means the more money you make, um, the more you should pay. Like, let's look at some regressive taxes. It could be argued that most user fees, fuel taxes, all those kind of things are regressive taxes. Even a speeding ticket. If you're flying down the Glen and you get $100 ticket, if you're somebody who's got quite a bit of wealth, yeah, $100 ticket, you're not going to worry a whole lot about it. If you're somebody trying to get to your job at wherever for minimum wage, $100 is going to leave a mark. And so anyway, those fees, and the same is true with DMV fees, where they're you know kind of the same for everybody. For the real wealthy, it's not much of an impact. For lower income people, it is. So anyway, the IRS does try to you know get things back into progressive realm in terms of income taxes. Sorry about that. We got a new puppy in the house. So anyway, we got single, married filing jointly, married filing separately, head of household, qualifying widower. So single, if you are single and you're making 100 grand, you're going to get taxed quite a bit compared to somebody who's married. Between the two of them, they're making 100 grand. Those two people in the married category are going to pay less in taxes than the one single person. Head of household, um, there's also credit given when you have children. Your children can qualify. Um, let's say you're a head of household. Well, you're not, in this case, by definition, you're not married, because if you were married, you'd be filing in one of these two categories because it's more advantageous. But you're not quite single because you've got a qualified dependent, meaning a child or something like that, maybe an elderly parent or somebody living with you, somebody dependent upon you. So they throw you a bone. You can file as head of household, which puts you down in a lower bracket, um, rather than single. Qualifying widower. So obviously, this qualifying widower used to be, by definition of the word widow, used to be married, and you got enough bad things going on. So rather than throw you under the bus and make you file single, they allow you to file, in a different status again, which I've never obviously filed that way, but I assume it's definitely preferential to single. So here's a 1040 tax form, and it's really whatever, mindless calculations. Subtract line this from line that. Look to the column here, look on the chart, and he gets so wrapped up with the paperwork that you lose track of what you're trying to do. And what you're trying to do is pay your taxes, not overpay. We're not talking about tax evasion. Tax evasion is not paying your taxes, not filing your returns, cheating, all that kind of stuff. And the penalties are harsh for tax evasion. But minimizing your taxes, taking, whether you want to call it a loophole or a deduction, a tax break, things get into the tax code by basically politicians putting them in there. So again, if you're, taking advantage of some loophole you get for adopting a child, well, that's not really a loophole. I mean, that's a pejorative term for something that was put in there because it was determined to be, a good deal for society. Now, not all of them are as clear cut as adopting a child, but if you're investing in property and have children and do all these other things, those things have been viewed as positive, and you end up paying less on your taxes. So if you're not wrapped up in this form, is what I'm trying to say, and you can look more at the strategy part of it in terms of how to pay as little as possible on your taxes, that's where your time should be better spent. And obviously, with all the software out there, or perhaps people you're going to hire, that's how it's done. So again, like I said, if you cheat on your taxes, you will, it's ugly, because what happens is, let's say there's a drug dealer or somebody out there trying to catch some guy with drugs, some big dealer. It's hard to do, and people get shot and stuff. It's very easy to find some dude with $1 million, and the IRS can walk in and go, "Where did you get this $1 million?" And you have to show your, receipts or your pay stubs for where that $1 million came from, which if you're a drug dealer, that's pretty much impossible. So therefore you go to jail. So they don't have to catch you with the drugs. They just catch you in the financial situation with all this money that was never put on these forms. So that's why the penalties are maybe disproportionately severe, is because, the IRS is used to prosecute a lot of crimes for which are hard to prosecute. But it's very easy to, look at somebody's wealth and ask them where it was filed for on the returns and how did you come about it. And if you can't provide it, you know, you go to the same jail. So it's anyway, penalties are harsh. I've never been audited, thank God, and I mean I'm not fearful of it, but um, anyway, most people are though. Most people overpay their taxes just because they don't want to, the IRS snooping around. That's probably the wrong attitude. You can go too far either way on this. So anyway, the tax code is out there. Every rule that's put in there is meant to be used. Now, obviously, some whatever on YouTube or some free information you get, be very careful of just randomly picking up some strategy. What you want to do is you want to find kind of three sources for everything. First, the source of, oh, I hear I can deduct, whatever, something with Bitcoin or something like that. I think that's legal. Find it somewhere else, preferably by one of these tax information type things like there's all these tax guides out there. They used to be printed, but now they're online. But anyway, they're not just one person's opinion. They're attributable to, a CPA or some sort of accounting firm. Anyway, if you find that document will link, will have some sort of footnotes or references back to the IRS source document. And then you go in the IRS source document and you find out that it's actually true. If you try and do it in the reverse order, if you jump right into the IRS, their pubs are not typically very user friendly, not typically searchable very well. So anyway, but if you go through that process and you actually find it spelled out in the IRS code, then you can be, assured. And if it is something rare, sketchy, definitely print out those documents. I did a bunch of real estate stuff where I put property under an IRA because I wanted the property. The stock market was screaming, and it was like a time like this where everything's kind of falling apart. So I wanted to stabilize my money. So I transferred that IRA, which was all held in, stocks, mutual funds and stuff. I transferred that into real estate. I had to find a company that could do that, but they can, and it's allowable per the code. And anyway, it worked like a champ. But anyway, it's not something you just do. You have to find to make sure that's legal. So anyway, these are the forms. The reason why I'm not going to go through it line by line is because those forms, when you're doing it on something like TurboTax, TaxCut, whatever software you prefer, it's just a drop-down menu, and then at the end of the process, it spits you out that 1040, and it's just very nice. Anyway, when we're talking about income, gross income, that's everything. So this is before, you know, taxes and stuff are there's no modification, no adjustment. This is just everything all grabbed together. Wages, salary, interest, loans, dividends, capital gains. Remember what I said about short and long term? So again, shorter than 12 months, longer than 12 months. And just as I said, the rate for long-term capital gains is about 15%. The short-term capital gains is whatever your earned income rate is. And we'll talk about that when we look at tax brackets. So if you're, not a high earning individual, just, on the verge of welfare, then short-term capital gains, long-term capital gains, these could be almost the same number. But if you're, making 100 grand or so, you're going to want to employ some strategies, if at all possible, to make them long-term capital gains. So exactly what I was saying. Long-term, yeah. Why don't just say 15%? It's typically 15%. There are some exceptions. I guess that's what hedge your bets. Okay. So they're going to start filling out the forms. But again, you know, if you're actually putting pencil to paper, I just don't think it's a very efficient use of your time. Your strategies ought to be applied to, um, you know, looking at your overall situation. Different schedules that accompany them. So we had B, Schedule C. I've got a Schedule F since I'm a farmer. You've got different schedules, different forms, different worksheets. So now we're getting to AGI, adjusted gross income. So contributions to individual retirement accounts, alimony payments, interest paid on student loans, if your income, I found this out, if your income's below a certain level, and other special circumstances. So anyway, um, the point of contributing to an individual retirement account is, let's say you're making 100 grand and you have deductions of say 20,000. When you go to fill out this 1040, your adjusted gross income is going to go down to 80,000 because that 20,000 is going to come out plus whatever other things you had. Um, Standard deduction. The IRS has always got two things. They go, you know, why bother? We know everybody's going to have deductions. We're going to set up a certain just what if kind of deduction. It's going to be put out there and it's going to be whatever. It'll depend on your filing status and stuff. But it'll say, you can add up all your business expenses. You can add up all these, you know, home expenses, all these things that are qualifying. Or you can just take, say, 20 grand. That's what we're saying. So anyway, it becomes a comparison between the two numbers. It's probably easier to explain standard deduction when you're actually doing your taxes. But you'll get to the end of the section where you add up all your deductions, all your, donations to charity, all your, losses you've had, everything you had going on. And if that number is less than the standard deduction, well, then you'd be foolish not to take the higher standard deduction. But if it's more, then you skip the standard deduction. I can't remember. I haven't taken a standard deduction. It's got to be over 30 years. So anyway, this doesn't happen if you've got a lot of different things going on, and you structured your finances and stuff to maximize your deductions. So now again, these numbers are different from back then, but this is what I was talking about. Where okay, if you're married filing jointly, 12,600, right, is your standard deduction. For head of household, 9,250. Single is going to be the worst. And then married filing separately is married filing singly, basically, is how that states. So it's the same number. Itemized deductions can be deducted to reduce taxable income. So, yep, interest expenses paid on mortgages because of real estate. So obviously notice that interest you pay on your credit cards is not tax deductible. So that's what I'm talking about when I say not all interest is the same. State income tax. This got very ugly, very political. You'll hear people talk about SALT. This is red versus blue. Trump came in and said, all these states, California, New York, whatever, they're running up these huge budgets and they, the way they sell us to their taxpayers is like, don't worry about your state taxes because you can deduct them against your federal taxes. So if your state like California's got 63%, combined tax if you're a high wealth person, that's a big deal to you. So you're looking for a way to deduct those state and local taxes. And when Trump did that, that's why he was not popular in those states, one of the reasons. But why he was popular in other states like Alaska, perhaps, and others, is because anyway, the deductibility of state and local taxes looks like it's coming back, obviously, because it's a different administration. So, um, yep, real estate tax imposed. So again, like I said, when you're buying a home, you can deduct not only that mortgage interest, but all the real estate tax. Medical expenses. This is kind of sad though. You got to be pretty sick. So this is in excess of adjusted gross. And this is not what the insurance company paid. This is your chunk, all your bills are 10%. So, again, if you're making 100 grand, you had to have $10,000 of excess, So you're pretty sick. Charitable gifts, that's awesome. Comes right off the top. Okay. Not a one for one. These are deductions. These are not credits. A difference between a deduction and a credit. So, yeah, we'll go in that in a second. But it's, when somebody says donate to us because it's tax deductible, that's a good thing. But it's not the same. I guess I got to go into it right now. Okay, so this is how it works. If somebody gives you a tax credit is fantastic. A tax credit is maybe for, say there's some solar car or electric car kind of thing, and you get a one for one credit. So let's say you get $1,000 tax credit. You get to deduct $1,000 off your tax bill. So that's a very, very big deal and used in only, special situations. Tax deductible, on the other hand, though, that's a whole different thing. What that means is, let's say, and we're going to jump into tax brackets here. Let's say you're making $100,000, and for argument purposes, let's just say you're paying 30% in taxes. You're that amount of money, those last dollars you're making, are being taxed at a rate of 30%. And so you donate $1,000, and that gives you $1,000 tax deduction. So what that means is you can lower your income by $1,000 as reported to the IRS. It reduces that adjusted gross income. How much money does that save you? Well, if your income still had that $1,000 listed on it, you would owe 30% of that in taxes. So by making a $1,000 donation, it's only costing you $700 because you would have had to pay $300 in taxes on that. Anyway, we'll go over that again if it's confusing you. It reduces your tax liability by reducing your income, but it does not do so in a one-for-one nature. It just means that if you would have made $1,000 more, you would have had to pay $300 more in taxes. Since your records now show that you made $1,000 less, you save $300 in taxes. So that $1,000 deduction you made, or $1,000 donation you made, realistically only cost you $700. But certain groups are, certain things are charitable, and that's 501(c) and other type things. But, you donate to a political campaign, well, that's not tax deductible. You donate to a registered charity, and that's why it's important. You keep receipts, and you make sure you're dealing with, recognized charities. I've done this before where, the car gets totaled out. I just had collision on it. Granted, we're not talking a high dollar car, but a couple, $3 grand. Something gets stolen, something gets just destroyed. job expenses, if not, um, well, if not substantial, I can make them substantial by adding them all up. Let's say, you've got a job and now the employer cannot reimburse you for this, but let's say you're an engineer and you subscribe to some engineering society for professional development and you get their magazine and you do this to kind of keep up in your field or let's say you don't have a clothing allowance for your job, but there's still a requirement that you dress in a certain way. You have dry cleaning expenses that probably are not covered by the employer. You have, anyway, all kinds of things, and stay within the lines, but you can get a bit creative, and if they're legit, it's going to come down between you and the auditor, and if you're not comfortable defending it, then it's probably not legit. But if it's something that you're truly doing, if you're I'm sure for school teachers, unreimbursed supplies and things that you purchase out of pocket that you're not getting reimbursed for. Those are legit and they can be deducted. So anyway, you're going to get all those numbers, you're going to add them together and you're going to hopefully exceed that standard deduction and you're going to say, "Nope, keep the standard deduction. My deduction is probably double, hopefully." Just, because you're you're living life and you're doing well. So anyway, Schedule A, I do not know all these schedules. I mean, I'm familiar with them, but I don't know A equates to itemized deductions because I don't go to the forms. I spend my time, as you should, on how to work this stuff out. And then TurboTax that we'll talk about here in a second. But the TurboTax bit is number one, you can run those trial situations like I was talking about. You can run them fairly early in the year. Sometimes they change the tax code a little bit, but they have the most up-to-date stuff, and it's just fairly user-friendly, and it keeps your profile. Exemptions. Has to do with when you're talking about the number of dependents you have. It's going to affect the way you go into the chart to see how much you owe. So, obviously for all of these things, especially, since divorce is quite common or any kind of situation where you have, minor children who may be claimed by one parent. The big rule is you can't both claim it. It's got to, whatever, if that were to happen, if both people claim the tax benefits of the same child, that is a big problem. And it's fairly easy to figure out because you're using social security numbers for everybody, including the children. Calculating taxes, and here they go with this progressive tax, positive relationship. Anyway, it just means the more money you make, the more you get taxed. This is 2021. So this is tax practice. So we're going to jump right in. The video will do a good job of it too. If you can't follow me, but I think you're going to be able to. When people talk about tax brackets, when I said somebody's a fool who says, "Oh, I don't want to take that new job because it's going to push me in a new tax bracket," that's ridiculous. Now there are certain things out there, like sometimes maybe the deductibility of student loans or deductibility of this or that. If your income's over a certain level, you may not qualify for that program. Fair enough. Those things you can kind of keep track of and maybe strategize. Right now, there's actually some people who are doing this for medical stuff too. I want to qualify not for Obamacare because or whatever, Affordable Care Act, because it's pretty high. I want to be down in the Medicaid range. I want to be down in the welfare range. So I don't want my income above a certain level. And, people do what they got to do. But this is the way actual tax brackets work when people talk about tax brackets. So here are the rates, right? So when I said a 30% rate, you can tell I was just kind of pulling that whatever because there actually isn't a 30% rate, or at least there wasn't in the 2021. The way taxes in 2021 is actually the current year. Taxes are always done in arrears, right? When you're doing your We're in 2022, but we're not filing our 2022 taxes. We're filing our 2021 taxes. We're filing last year's. So these were the current rates. So what happens is for the first 10% up to just short of 10,000, so kind of a coincidence there. So somebody who's making from 99.50 up to 19,900, and we've got different categories. Okay, so now I'm even confusing you guys more. So this was for singles, this is for individuals, this is head of households. I'm going to just go through the individual category since it's close and it'll keep me from screwing up. Okay, so you're not quite making 10 grand. You still have to have some skin in the game, though. The government still wants you to pay a little bit. Now, in reality, you're actually getting money back because you're going to qualify for other programs. But anyway, on your actual income, what's going to be taken out or what should be paid at the end of the year is 10%. Okay? Now, that next dollar that you earn, that from 99,951, this little tranche right in here, this segment from 99,951 to 40,525, you're going to pay 12% on that chunk of money. Not all the money. This first chunk got paid at 10. This next chunk this next bracket got charged at 12%. This next bracket goes from 40,526 up to 86,365. Okay, so you can see how it starts to work up. Now let's say, you're talking to this person who's not quite that bright on taxes and they're like, I don't want to take that, pay raise. It's going to put me at $87,000 because that's going to put me in the next tax bracket. No, what's going to happen is all your income, first chunk's going to be taxed at that, second chunk's going to be taxed at that, the next chunk's going to be taxed at that. And since you're making 87,000, work with me on the math here. What is that? 625, 3,625. That little chunk, that last chunk of 3625 is going to be taxed at 24%. That $3,600 is the only segment of your entire income that's going to be taxed at the higher tax bracket. So it's make as much money as you can. Now it may get to a point, but even so, these numbers are not going that high. But it's gonna disincentivize some of these people. 35 or 37%, who cares? Now, if they come up with some millionaire's tax, that may be a different thing, but those things don't really exist right now. And this is only the federal too, which for Alaska, that's all we got. If you're in a state, they could have their own tax brackets and their own numbers. But this is how tax brackets work. It's this chunk in here. So how much, let's say a person's making $100,000, how much of their income is being charged at a 24% rate? It's only that segment above 86 to there. Okay. Now you could do some math if you wanted to, and you could add up all these numbers if you knew your exact income, and you could do a little math and figure, oh, I'm paying an average tax rate of say 17, 18%, whatever it is. But that's not how the IRS calculates taxes. They don't take an average tax. They do it in brackets. And the brackets, like I said, so this dude here, single, worst case, he's up in the 24% tax bracket just when he hits 86,000. Now, here's a couple, they're married, filing jointly. Well, their combined income needs to hit 172. So you got the stay-at-home whatever spouse or dude, or well, they're still a spouse, aren't they? But anyway, they're not going to be in that racket, so they could whatever. The IRS, yeah, is going to hit single people a little harder, and that's why head of household will try to want to get out of that as well. But they're only a single. Well, they're not a single well, they are a single person, but they have a dependent. Anyway, getting too far in. Long-term capital gains. So this is the long-term rate. Um, yeah, where I said 15% rate. And so when you get up in the big numbers, which I guess you can afford it, you're going to pay 5% more. If you're down in the low numbers, lower. Um, anyway, you're not paying a high rate. Now, if you had some, when we talked about combining all that income together, let me roll back. Let's say your income is, you know, 60 grand and you sold a bunch of Bitcoin this year and, you had another 60 grand. Well, because you did it in the short term, you're up in the 120 numbers and you're paying a couple percent more for tax. Obviously, you're not selling Bitcoin right now. It's not a good time, but anyway. Determine your tax liability. So, tax liability, tax on base, percentage base. Anyway, at the end, you go and you pull those numbers out, and the way it works for most people who work for an employer, there's been withholding taken out through the year, and you enter in how much has been withheld from your paycheck, and then you look at the chart, you find out what your actual tax liability is, how much you actually owe, and then the difference is what's to be paid or refunded to you. So, like I said, child tax credit, $1,000. You know, that is a credit. That is not. Children are not tax deductible. Children are credits, right? So you get all of that. College expense credit. Again, you got to figure out though there are certain income limits. 529 plans, things like that. What's going to happen here is I guess we'll get into it right now. In terms of like term paper, right? You say, okay, one of my goals on my long-term financial plan is to save for my children's education. And you just put it in a regular stock, or mutual fund thing, a regular investment. You just open up a brokerage account and put it in there. That's not going to work very well for you in life or for your grade because there were better ways you could have done that. Your investments could have been exactly the same, but if you would have characterized it, if you would have put it into a college savings plan, which is, recognized by the federal government or Coverdale, kind of same thing, all of that money that goes into that account, it can be the same exact investment, but since it's characterized as a 529, when that money is pulled out, all of that income is tax free, right? So it makes a huge difference. So if you save your child, and some of you are probably beneficiaries of this. Let's say your parents go on and they saved you 50,000 or 100,000, and they put it in a proper 529 plan. You get all of that money. If it's in a regular thing that's going to be added into their regular income, they could still give you the 50,000 equivalent, but unfortunately the IRS is going to want their chunk first, so now you're down to 35, 40, so it's not as good. So anyway, don't do that. And there are certain penalties, but they're kind of livable. Basically you got to go back and pay the tax if whatever Johnny or Susie becomes a burnout and doesn't go to school and they don't withdraw that money. It's not like the money's gone. It's just it you just have to charge it differently. Pardon me. Okay. Earned income credit. Yep. Always a block on the taxes, but I've never had it because anyway, you end up in low income. But child care, adoptions, things that are good. There's again when you hear people, we need to get rid of that tax loophole. Well, sometimes they're loopholes, but sometimes they're valuable things that are write-offs that are put in there to manipulate people into being better people. So more TurboTax stuff. And then homework. Okay, so we've talked a little bit about that stuff. Now I'm going to show you a few things. So this thing probably aged out on me. Progress has been saved. Let's see it. So I've got a bogus TurboTax account, and you could do the same thing. you know, I set it up under my Alaska account. Mm, it's always a spelling test, sorry. But what you can do is, you could use legitimate info in here if you wanted, but I actually do use TurboTax once in a while for different items. Number one, they're a lot more security conscious than they used to be. Um, Never. And they had all my information in here beforehand. My profile. I've done this with these. Oh, it's going into Credit Karma. I'm sorry. My bad. How'd we get in a? I guess I'm gonna have to take this out. They own everything, don't they? So I've probably already frustrated you with TurboTax. But again, you get what you pay for. This stuff, I'm not paying anything for it, so they're trying to steer me to Credit Karma to get me to sign up for that because they own all of that. They even own Mint too, if you guys tried that. Okay, now we're rolling again. Okay, so personal info, all of which is bogus. Um, because again, I've never filed with this. They think I was born in 81. Part of my last name. I live in Alaska, obviously, because it's going to be, I want to make sure things are proper. No, wasn't blind. Obviously, taxes are different. Nope. I want to change. No. So you're going to pick your category here. Now, this is another thing. When you saw that married filing singly or married filing jointly, and you've got extremes in incomes or some weird situation, the beauty of TurboTax is you can just file one way, see what the numbers turn out to be, for two incomes or with two single returns, or go do it again, filing married. Sometimes it changes. There was a point in time they used to call it the marriage penalty, and people in certain situations would get divorced once a year just for taxes. All you have to be is divorced one day out of the year to claim you're in that category, and it's stupid that the government was kind of incentivizing that, but I mean, anyway, that current law had been changed, but there's still financial situations where it does make a difference. When they talk about supporting, they'll go through all the details on this. But what I really want to do, you see how it could be a child, it could be an elder. I'm just going to put no one just to get us through here. Okay, continue. It wants an address. It knows it live in the valley. Make money in other states. I'm going to jump right through there pretty quick. It evaluated my status. Mailing address. It doesn't. I'm not going to give it a whole bunch of information because I just want to go through and show you some of the deductions. They want to sell you something again. Let's get started. W-2s. You're familiar with W-2s. So it's the document you're getting this time of year. Employer number. I'm going to try and skip through this. Some of these things too, it's very slick where you can put in your employer information and it will actually download it if you're working for a big firm or somebody's associated maybe with ADP or something like that, one of the big central payroll processors. It's kind of cool. I'm just going to tell it I'm typing in myself, and I'm just going to put in some random numbers or nothing. Yeah, it's going to want something. Okay, and Okay. Yeah. Even though I won't turn this in, I don't want too much information in there. Oh. Okay. What we're trying to do, and what you can typically do, is jump to deductions on here. Um, Again, sometimes these things can be a little annoying, but if it will allow me to do this, oh man, just come on. Oh, quit. I'm sure I've sold you all on TurboTax. I'm just fighting this annoying. No, I don't care. Let it go. It's going to go through and ask you every one of these questions. Okay. I think I'm going to have to edit this part out. Alrighty then. So, all right. So this is what I want to show you. Up here, this is kind of nice. I entered in some data back on my W-2, and what I showed was that I made $100,000 and I had 20,000 withheld, which based upon all the numbers I basically took out 20%. Well, because we know the tax brackets, I actually withheld a little too much. My average tax rate would be probably closer to about 15,000. So anyway, it's showing that I'm due a refund. That, if all things being equal, if nothing else changes, and hopefully, if I already overpaid, if I take some deductions now, I should actually get some money back. So what I'm going to show here is, let's say you were paying a home loan. You own a home and you're paying for it. So you get a 1098. 1098 is a little form. Renters do not get these, right? It can go through and then enter all this stuff in, but I'm not going to do any of that. I just want to type it myself. Okay, and that's the bank. Do any of those things apply? No. And those aren't typical. And so let's say the mortgage interest for a standard home, depending on the interest rate, shoot, if you're paying, say, 1,500 a month, 2,000 a month, let's just say 2,000 a month on a mortgage payment, and it's a home that you just recently purchased, a good portion of that is interest. So let's say, oh, I don't know, it's per year. Let's say it's a big whopping amount. Let's say it's $18,000 worth of mortgage interest that you paid. Okay, outstanding principal, I don't know, 400 grand. These are all just funny numbers. The important number is this number up here, because I just want to show you the effect that it's going to have. Mortgage insurance, no, not paying it. I don't think we have to pay it. Now, here's the other thing, real estate taxes. If you live in the municipality of Anchorage, this number is going to be high as well. Let's say, I don't know, maybe 9 grand again. So now we've got all this money that, we have paid for living in our house. And let's see what effect that has on the interest. Well, whatever. You try to get by with not putting many numbers in here. And whatever. Say it was 2010, something like that. Loans incurred, yes, because the property is the security. See what happened on our refund? So we went from about 5 grand, we got about 3 grand of that back. I mean, it's not all of it back, but it's pretty nice. And then you can go on with primary homes, secondary homes, things like that. So that's kind of cool. Let's go back and look at one more thing, see if we can get it in a broader sense. Remember when I talked about donations to charity? So let's say, you're a good person. Who did you donate to? It should be a registered, charity. So let's say Goodwill. Keep the receipt. Now, what did you donate? I mean, obviously, it's probably me and the items if it's Goodwill. So household items. They can show you, they've got things to kind of guide you and give you evaluations. Or, I choose to value myself. And so what you should know is, basically used prices for stuff. If you were to, rather than give it away, if you put it out on Craigslist or something, what is the value of it? There used to be a lot of scams here with vehicles where people would, donate beater vehicles, claim they're worth money. That has kind of gone away. You notice the ads, the whole donating the car, because now what's deductible is actually the salvage value, and it's not nearly the same. So the charities kind of got hurt on that thing. The only important thing about this date is that it's got to be, in 2021 to make it the correct tax year, right? And let's say it was household items, whatever. So, yep. Let's say it was a silly whatever. Just put furniture. Does not matter. And let's say for all those items were $1,000 worth of value. And you went with comparative sales, what you thought you could sell it for or have sold it for before. Okay, so we donated $1,000. This is a tax deductible donation. So how much is this number going to change by up here? It should go up in terms of a refund about $250, right? Boom. And there you go. So that's how deductions work, things that are tax deductible. Now, if that would have been a $1,000 tax credit, this number would have gone up by 1,000. It would not go up by a percentage based upon your tax bracket. No, it would go up by a whole different number. So, anyway, it's interesting. It's pretty powerful. It goes through and asks you all these questions in sometimes an annoying manner or it asks you strange questions. But if you go back and look at the tax code, most of the time those things are in there and you can go in here and you can see the actual forms that have been basically auto-generated as you've compiled it. So it can be worthwhile. Anyway, it's just one more method of working on your taxes. And like I say, I've never under this account, I've probably had it for 6-8 years, and I've never ever given TurboTax a dime, but I have used it to look at different tax situations because they have got it all kind of put together in an easy format. Um, and then the homework was such. Any other questions? Until next week.